$7 trillion in precious metals value vanished in 48 hours. Gold crashed from an all-time high near $5,600 down to $4,600. Silver collapsed 31% in a single trading session. The worst day for the white metal in 46 years. Mining stocks got decimated across every exchange. Leveraged traders received margin calls that erased months of carefully accumulated profits in minutes. Trading desks around the world descended into controlled chaos as positions that took months to build evaporated in hours. Fortunes were made. Fortunes were lost. And for millions watching their screens in disbelief, one question dominated everything else. Is this the end? Then something happened that nobody anticipated. J.P. Morgan, one of the largest and most influential financial institutions on the planet, released a research note right in the middle of this historic carnage. They did not lower their gold price target. They raised it to $6,300 per ounce by the end of this year. That is not a misprint. While the market was bleeding, while panic gripped trading floors from New York to Shanghai, the most respected precious metals desk in global finance doubled down on their bullish conviction. How is that possible? What do they see that the panicking crowd does not? Is this the contrarian signal that separates sophisticated institutions from retail traders who sell at exactly the wrong moment? That is exactly what we are going to unpack today. Every catalyst that triggered this historic collapse, every hidden force that amplified the damage, every detail that mainstream coverage is glossing over, and most importantly, what the aftermath might mean for anyone watching the precious metals market in 2026. Let us start at the beginning. Thursday, January 29th, 2026. Gold had just touched $5,500 per ounce for the first time in human history. Take a moment to appreciate the magnitude of that number. Just 2 years earlier, gold was trading around $2,000. The metal had nearly tripled in value, and the rally showed no signs of slowing. Silver was even more explosive. A white metal crossed $120 per ounce, obliterating records that had stood since the Hunt brothers' infamous attempt to corner the market back in 1980. Platinum hit all-time highs. Palladium surged alongside. The entire precious metals complex was moving in lockstep, propelled by forces that seemed unstoppable. Central banks were accumulating at the fastest pace since the Bretton Woods Agreement established the modern monetary order after World War II. The World Gold Council released survey data showing that 43% of global monetary authorities expected to increase their gold reserves over the coming year. That is a record level of institutional conviction. These are not day traders chasing momentum on a chart. These are the custodians of national reserves making strategic decisions measured in decades, not days. ETF inflows were shattering monthly records. Physical demand for bars and coins was overwhelming the capacity of refineries to produce product. In China, retail investors were lining up outside bullion dealers before dawn, willingly paying premiums of 20 to 30% above the spot price, just to get their hands on physical metal. One analyst described the scene as speculative mania of a kind not witnessed since the dot-com era. The rally had taken on a life of its own. Momentum traders amplified every move. Rising prices attracted more buyers. More buyers pushed prices higher still. The feedback loop became self-reinforcing, creating a machine that seemed to manufacture wealth out of thin air. And then came the news that changed everything. At approximately 10:30 in the morning Eastern Time, on Friday, January 30th, reports began circulating that President Trump had made his decision on who would replace Jerome Powell as the next chair of the Federal Reserve. The name leaked to journalists covering the White House beat, Kevin Warsh. Within minutes, the precious metals market went into freefall. Gold plunged 9.8% in a single session, the largest one-day decline since 1983, more than 43 years. Silver suffered even worse. it collapsed 31.4%, marking the biggest single-day drop since March of 1980, when the Hunt brothers' squeeze finally collapsed. One equity strategist at Miller Tabak described the scene on trading floors with 4 words that captured the moment perfectly. "This is getting crazy." He went on to explain that most of the selling was probably forced. Silver had become the hottest asset for day traders and short-term speculators over the preceding months. Leverage had built up to extreme levels across the futures markets. And when the initial decline started, margin calls went out to thousands of accounts simultaneously. Traders had no choice. They either deposited more capital immediately, or their positions would be liquidated. Most could not come up with the cash, so they sold into a market that suddenly had almost no buyers willing to step in. The collapse fed on itself, but it did not stop on Friday. On Saturday, the CME Group announced it would be raising margin requirements on gold and silver futures effective Monday. Gold margins jumped from 6% to 8%. Silver margins increased from 11% to 15%. This is a technical detail that most casual observers miss entirely, but it is absolutely crucial to understanding what happened next and why the damage extended so far. Margin requirements determine how much capital a trader must maintain to hold a leveraged position. Think of it as a collateral requirement. When you trade futures, you do not need to put up the full value of the contract. You only need to post a percentage as margin. This allows traders to control large positions with relatively small amounts of capital. When margins increase, the rules of the game change instantly. Traders who are already operating near their limit face a binary choice: either deposit more cash into their accounts immediately, or see their positions force liquidated by their brokers. When this happens across thousands of accounts simultaneously, the result is a cascade of mechanical selling that has nothing to do with any trader's view on fundamentals. It is pure deleveraging, and it amplifies whatever directional move is already underway. That is exactly what happened on Monday morning. During the Asian trading session, gold plunged another 10% before bouncing back from the lows. At its worst point, the metal touched $4,500, down more than $1,000 from Thursday's record high. Silver fell to $75, erasing weeks of gains in hours. Platinum dropped over 4% from its record. The entire commodities complex was engulfed in selling that dragged copper, oil, and base metals into the vortex. One veteran commodities strategist at MKS PAMP described the precious metals market as broken, given unheard-of volatility. Another analyst noted that prices had become totally detached from where physical demand is robust. The mechanics of modern markets had overwhelmed the fundamentals that normally anchor prices. So what actually caused this historic collapse? To answer that question properly, you need to understand what was driving the rally in the first place. And that requires going back several months. Throughout 2025 and into early 2026, sophisticated investors had been accumulating gold and silver based on a thesis that became known as the debasement trade. The core idea is elegantly simple when you strip away the complexity. If the Federal Reserve keeps interest rates low to accommodate massive government borrowing, the dollar weakens over time. Inflation stays elevated above the Fed's target. Real interest rates remain negative, meaning cash loses purchasing power sitting in the bank. And in that environment, hard assets like gold become extremely attractive as a store of value that cannot be printed into oblivion. This thesis gained enormous momentum as the evidence supporting it continued to accumulate. The U.S. federal deficit continued to expand with no meaningful effort at restraint from either political party. Government debt crossed $36 trillion. Interest payments alone consumed nearly $1 trillion annually, more than the entire defense budget, and rising with every tick higher in rates. Every projection from the Congressional Budget Office showed the situation deteriorating further over the coming decade. geopolitical tensions escalated in ways that seemed to confirm investor fears about global instability. In January, U.S. forces captured Venezuelan President Nicolas Maduro in an operation that stunned observers around the world. President Trump had repeatedly threatened to take Greenland by force. He sent what he described as a massive naval armada toward Iran, warning that time was running out for Tehran to accept a nuclear deal. The possibility of military conflict in the Middle East felt more real than at any point since the Gulf War. Gold responds to uncertainty. It always has, and the world in early 2026 offered uncertainty in abundance. The metal rose 64% in 2025 alone, its second-best annual performance since 1970. Silver did even better, surging over 145% as industrial demand combined with investment demand to create a perfect storm of buying pressure. From its low point in January 2025, around $30, silver had climbed to $120 by late January 2026, a gain of over 200% in barely 12 months. Some veteran traders said they had never seen anything like it. The rally attracted every type of buyer imaginable. Central banks accumulated strategically, driven by concerns that crystallized after the West froze Russian foreign exchange reserves in 2022. That unprecedented action sent a message to every monetary authority on the planet. Dollar reserves can be weaponized. Gold cannot be frozen, sanctioned, or confiscated by any foreign power. For countries with complicated relationships with Washington, the logic of diversification into physical gold became impossible to ignore. Institutional investors rotated out of bonds and into tangible assets. With sovereign debt levels rising across developed markets and real yields negative or barely positive, the traditional balanced portfolio looked increasingly risky. Gold provided diversification that actually worked when stocks and bonds moved together. Retail investors piled in through exchange-traded funds and physical purchases. Gold-backed ETFs saw inflows that shattered records. Coin dealers reported demand they could not satisfy. In China, speculative fever reached levels that seasoned traders described as unprecedented. Premiums for physical metal in Shanghai soared to levels that created arbitrage opportunities for anyone who could source supply elsewhere. And momentum traders amplified every leg of the rally. Rising prices attracted more buyers. More buyers pushed prices higher. Headlines about new records attracted attention from investors who had never previously considered precious metals. The feedback loop became self-sustaining. But the entire trade rested on one crucial assumption that few examined too carefully. The assumption was that the Federal Reserve would remain accommodative, that whoever replaced Jerome Powell would continue the tradition of easy money and balance sheet expansion that had characterized monetary policy for most of the past 15 years. Kevin Warsh represents the exact opposite of that assumption. Warsh served on the Federal Reserve Board from 2006 to 2011. He was at the center of the policy response during the 2008 global financial crisis, helping design the emergency programs that stabilized credit markets when the entire financial system teetered on the edge of collapse. He worked alongside Ben Bernanke and Tim Geithner during the most perilous weeks in modern economic history. But Warsh emerged from that experience as a vocal critic of the policies that followed the acute crisis phase. He opposed quantitative easing and the massive expansion of the Fed's balance sheet that accompanied it. He argued that zero interest rates distorted capital allocation and punished savers. He warned that easy money was creating bubbles and imbalances that would eventually require painful correction. In a Wall Street Journal editorial published last year, Warsh argued that inflation is a choice made by central banks. He signaled a desire to aggressively shrink the Fed's balance sheet. He called for monetary policy that prioritized price stability over market comfort. When Trump nominated Warsh on Friday morning, the market instantly repriced everything. If Warsh takes the helm in May, when Powell's term expires, the era of the Fed put might be over. That implicit guarantee, widely believed by traders, that the central bank will always step in to support markets with liquidity when things get rough. That assumption that rates will stay low forever because the economy is too fragile to withstand normal monetary policy. That expectation of endless balance sheet expansion whenever markets wobble. The dollar surged immediately as traders bet on tighter policy ahead. The dollar index jumped more than 1%, a significant move for a major currency. Treasury yields spiked as the market repriced interest rate expectations higher, and the entire foundation of the debasement trade crumbled in real time. Several analysts compared the moment to Paul Volcker's appointment as Fed chair in 1979. Volcker famously broke the back of inflation by raising interest rates to levels that seemed unthinkable. The prime rate topped 20%. The economy plunged into a severe recession. Unemployment soared, but Volcker did not blink. He prioritized restoring credibility to the dollar over short-term economic comfort. Gold crashed after Volcker established his anti-inflation credentials. It fell from $850 to around $350 over the following years, entering a bear market that lasted nearly 2 decades. Is history about to repeat? This is where the analysis becomes genuinely interesting, because the comparison to Volcker, while instructive, has significant limitations that change the calculus. When Volcker took over in 1979, gold had risen from $35 per ounce to $850 over the preceding decade. That represented a gain of more than 2,000% during a period of rampant monetary expansion. The metal was massively overbought by any historical measure. Speculative fever had reached genuine mania levels. Today, the situation is materially different. Gold's share of total global financial assets remains modest despite the recent rally. According to J.P. Morgan Research, investor holdings of gold through ETFs, bars, coins, and COMEX futures represent approximately 2.8% of total assets under management across equities, fixed income, and alternatives. That is elevated compared to the historical average of around 1 to 2%. But it is nowhere near bubble territory by the standards of previous manias. Central bank buying is accelerating, not slowing. J.P. Morgan projects purchases of 800 tons in 2026, well above the pace of recent years. Deutsche Bank independently reached similar conclusions. The trend of reserve diversification has structural momentum that a single Fed appointment is unlikely to reverse overnight. And perhaps most importantly, the fiscal dynamics that help drive gold higher have not improved one iota. The U.S. debt load is still climbing. Deficits are still expanding. Interest payments are still consuming an ever larger share of federal spending, with no political consensus on how to address the trajectory. Gold responds to these fundamental forces over time. Short-term price swings can diverge from fundamentals dramatically, as we just witnessed. Positioning, leverage, and momentum can dominate price action for weeks or months, but over longer horizons measured in years, the metal tends to reflect the purchasing power of the currencies it is measured against. This brings us back to J.P. Morgan's remarkable research note. Just hours after gold touched its lowest point of the sell-off, the bank's commodity strategists released an update that defied the panic engulfing markets around the world. They raised their gold price target to $6,300 per ounce by the fourth quarter of 2026. That implies roughly 35% upside from current depressed levels. They projected central bank purchases would hit 800 tons this year, citing an ongoing, unexhausted trend of reserve diversification. They forecast ETF inflows of approximately 250 tons and physical bar and coin demand exceeding 1,200 tons. Their exact words captured the conviction with unusual clarity. Even with the recent near-term volatility, we remain firmly bullishly convicted in gold over the medium term on the back of a clean, structural, continued diversification trend that has further to run amid a still well-entrenched regime of real asset outperformance versus paper assets. Deutsche Bank reiterated their $6,000 target on the same Monday, citing sustained investor demand despite the correction. UBS had already raised their forecast to $6,200 earlier in the month before the crash occurred. These are not fringe analysts making speculative predictions to attract attention. These are the largest and most respected financial institutions on the planet. Their precious metals desks manage billions in client assets. They have access to data flows, positioning information, and institutional intelligence that retail investors simply cannot replicate. And they are all converging on the same conclusion. The long-term bull case remains intact. But what about silver specifically? This is where the story adds another dimension worth understanding. Silver is not merely a precious metal. It is also an industrial metal with applications that are growing at an accelerating pace. Solar panels require silver in meaningful quantities. Every photovoltaic cell contains the metal because silver possesses the highest electrical conductivity of any element. As the world races to install renewable energy capacity to meet climate goals, industrial demand for silver continues to surge. The Solar Energy Industries Association projects installations will double over the next 5 years, and every panel requires silver. Data centers require silver. The explosion of artificial intelligence has created unprecedented demand for computing infrastructure. Server racks, high-speed connectors, and electrical components all use silver in quantities that add up across the millions of machines being deployed globally. Electric vehicles require silver. The average electric vehicle contains significantly more silver than a traditional internal combustion vehicle. Batteries, charging systems, power electronics, and motor controls all incorporate the metal. This industrial demand provides a structural floor under silver prices that pure monetary metals do not possess. Even if speculative fever fades entirely and investment demand normalizes, industrial consumption continues to grow, driven by secular trends in electrification and digitization. The gold-to-silver ratio tells its own story. At the peak of the recent rally, the ratio compressed to around 46-1, meaning it took 46 ounces of silver to buy 1 ounce of gold. That was among the lowest readings in years, reflecting silver's dramatic outperformance. After the crash, the ratio expanded as silver fell faster than gold. J.P. Morgan noted that without central banks acting as structural buyers for silver the way they consistently do for gold, the white metal remains inherently more volatile in both directions. Their silver outlook was more cautious than their gold call. They observed that the drivers of the continued rally have become harder to pinpoint and quantify as prices move higher. But they still project a floor for silver around $75 to $80 per ounce, well above where prices traded throughout most of the past decade. So where does all of this leave observers watching from the sidelines? This is perhaps the most important question that emerges from the chaos of the past 48 hours, and it deserves a careful answer. The crash exposed in vivid detail just how crowded and leveraged the precious metals trade had become. When prices were rising, everyone wanted exposure. Speculators piled into futures markets. Retail traders bought mining stocks on margin. Chinese investors drove physical premiums to levels that defied economic logic. Technical indicators flashed overbought on every time frame analysts examined. That extreme positioning is now unwinding. In the near term, volatility is likely to remain elevated. Leveraged traders are still in the process of liquidating. The CME margin hikes will continue to pressure speculative positions that have not yet been closed. And until Kevin Warsh actually takes office in May and begins to clarify his policy intentions through actions rather than speeches, Uncertainty about the future direction of monetary policy will persist. Prices could fall further before they find durable support. Market structure events like the one just witnessed tend to unfold in waves rather than straight lines. The first wave of forced selling often creates opportunities for a second wave as stop losses get triggered and panic spreads to participants who initially tried to hold on. But here is what experienced investors understand that short-term traders frequently miss in moments of panic. Corrections serve a necessary function. They clear out weak hands. They wash out speculators who are only in it for quick profits and lack the conviction to hold through volatility. They create healthier market structures by reducing aggregate leverage and resetting prices closer to levels that fundamental demand can support. For those who believe the structural forces underpinning gold remain intact, and there is substantial evidence that they do, a correction of this magnitude is not necessarily a reason to panic. Central bank accumulation continues. Fiscal sustainability concerns are not improving. Geopolitical fragmentation shows no signs of reversal. The gradual erosion of dollar hegemony as the unquestioned global reserve currency proceeds at its own pace regardless of short-term market swings. For investors with longer time horizons and genuine conviction in their thesis, pullbacks of this nature have historically presented opportunity rather than disaster. Of course, nothing in financial markets comes with guarantees. Prices can diverge from fundamentals for extended periods, sometimes years. The Warsh appointment could mark a genuine inflection point that reshapes the investment landscape for an extended period. And every individual must evaluate their own circumstances, risk tolerance, time horizon, and investment objectives when deciding how to respond to dramatic market events. But consider the information embedded in what just occurred. Over the last 48 hours, the precious metals market experienced its most violent correction in more than 4 decades. $7 trillion in notional value disappeared from the complex. Leveraged traders were wiped out en masse. Panic engulfed trading floors from New York to London to Singapore to Hong Kong. And, in the middle of that carnage, some of the most sophisticated precious metals analysts in global finance responded by raising their price targets and reaffirming bullish convictions they had held coming into the year. That juxtaposition is not a contradiction. It is a signal about the difference between price and value, between short-term noise and long-term structure. The story of gold and silver in 2026 is still being written. The crash of late January added a dramatic plot twist that market historians will study for years. Whether this moment marks the end of an extraordinary rally or merely a violent correction within a larger structural move higher depends on forces that will unfold over the coming months and years. One conclusion seems beyond reasonable dispute. Whatever happens next, the precious metals market will command attention. The stakes are too large, the forces too powerful, and the implications too significant for the world to look away. The drama continues, and wherever the story leads, the implications matter for anyone paying attention to the future of money, wealth, and the global financial system.